Hello, this is Gary Stringer, Senior Portfolio Manager at Shelton Capital Management. Welcome and thank you for joining us for our first quarter 2026 review and outlook presentation. Now, regardless if you're watching the video or joining us on the audio podcast, we thank you for your time and we appreciate your interest. In this presentation, we provide a brief summary and an explanation of our current economic and market outlook. For more details, please contact your financial advisor, and thanks again for joining us. Now, the theme for the first quarter 2026 review and outlook is Beyond the Headlines, a Broader Opportunity Emerges. And what we mean by that is while the geopolitical volatility from the Middle East has captured the headlines and stoked a lot of market anxiety, we're actually seeing a very profound shift in the U.S. economy, a very positive move in the narrative. We think the U.S. economy is actually going to work its way through the current challenges and actually blossom in the decade to come. And what we're seeing is massive investment in research and development, largely related to artificial intelligence, but not only artificial intelligence, that is fueling, we think, a growth cycle similar to where we were in the 1990s. Now, also, the One Big Beautiful Bill Act provides roughly $100 billion in a corporate windfall by virtue of the immediate expensing of R&D investments, and $150 billion expected in additional household consumer tax refunds. And so that's roughly $250 billion in additional economic stimulus that is going to work its way into the economy in the months to come. Industrial production we're seeing as the strongest area of U.S. economic growth currently, which is a big change from where we have been. We think a very positive sign and an example of just how resilient and diversified and robust the U.S. economy is. We expect retail sales growth to actually exceed what we saw prior to the pandemic, largely as a result of a lot of the stimulus that we expect to see in the coming months. We remain overweight U.S. equities versus foreign equities, largely because of the other countries we think face higher risks from what's happening in the Middle East and other issues, and the U.S. is more sheltered from those risks than other economies. In addition, the move higher in long-term interest rates makes high-quality fixed income even that much more attractive for our income and balanced portfolios. Now, the broad outlook looking across the globe in terms of monetary conditions, this is largely driven by central banks around the world. For example, in the U.S., we think the Federal Reserve is still running a somewhat more restrictive monetary policy than we would like to see. Other areas are more mixed or neutral or even supportive around the world. Fiscal conditions are supportive in the U.S. I was just describing some of what's happening as a result of the One Big Beautiful Bill Act. Leading indicators around the world are rather mixed. With respect to broad economic trends, equity valuations in the U.S. are also mixed, but that's because we see much of what led the stocks that led the recent rally coming into this year looked kind of expensive, but that left a lot of opportunity in other areas of the U.S. equity market that are much more attractively priced. So overall, we're cautiously optimistic on our outlook. This slide here that we're looking at, this is private fixed investment. In fact, it's non-residential private fixed investment, so it excludes household investments. And it's focused specifically on business investment in plant and equipment, for example, and research and development. And you can see how over time this line moves higher. And we actually saw an acceleration in the mid 2015 to 2017 kind of era, where businesses started to invest more in U.S. industrial capacity, and that's only accelerated since the pandemic. And historically, investments like this actually pay off in the years to come with respect to a higher productivity growth. So the labor force becomes actually more productive, allowing for stronger economic growth over time. And here we can see that this is average output per hour by decade going back to the 1980s. And you can see how, for example, in the 1980s, output per hour grew at roughly 1.5% over that decade. But then it accelerated in the 1990s and even further into the 2000s. And that's, we believe, as a result of all that investment in business investment in that infrastructure that created the internet and so forth, the information revolution. We think we're seeing something similar today that won't just be in the 2020s. We think it'll take us into the 2030s, similar to how investments in the 80s and 90s led to faster productivity growth in the 2000s. So this is not a near-term story. This is a longer-term benefit to the U.S. economy that we are very excited about. Also, we're seeing economic activity in the U.S. kind of broaden and significantly. I mentioned one of the strongest areas of the U.S. economy today we think is industrial growth. And what we're seeing here, these are purchasing manager index surveys. So these are business surveys for the manufacturing sector as well as the non-manufacturing sector. And the U.S. economy is primarily non-manufacturing or service-oriented. And so we economically weight these two figures on our proprietary measure to kind of match that, to reflect that more accurately. But what we've seen is, as we compare the 3-month moving average to the 12-month moving average, this shows us is this activity accelerating or decelerating? And what we're finding is that activity, especially in the manufacturing space, is actually accelerating for the first time in years. And so this is actually a very positive sign for the U.S. economy. So we're seeing a lot of, this is actually reflective of how broadly diversified and robust the economy actually is. The U.S., not every economy is like this, but the U.S., we do have the benefit of a very broad and robust economy. Further, within these surveys, when we look in the underlying data, we're seeing an uptick in new orders. So that's what we're looking at here, is how much new business is coming in on the books. And this is a leading indicator. And we're seeing an uptick in new orders, both in the service sector and in the manufacturing sector, as businesses continue to reshore, for example, and bring more manufacturing and industrial production into the U.S. So we're actually expecting to see an acceleration in this in the coming months. So investment implications. The challenge we've seen recently with the high correlation between stocks and bond markets, where they both sold off at the same time as interest rates move higher, that is absolutely frustrating. And it reminds us of what we saw in 2022 when there was really no place to hide. But like what we saw in 2022, we think that's a temporary phenomenon. And as we move forward, we expect these relationships to move back to normal. So on equities, we remain overweight domestic allocations. As I mentioned, we think other countries are going to be more exposed to the risks associated with imported energy and fertilizers versus the U.S., where we're actually net energy independent. And we're not reliant on Middle East for fertilizers. For example, roughly 30% of the global production of fertilizers passes through the Strait of Hormuz, so that's being challenged right now. The U.S. doesn't have to worry as much about that. Not that we don't have to worry at all, but not nearly as much. So this has us favoring areas like industrials, financial services, especially U.S. regional banks, energy, the energy sector, and materials. On the fixed income side, while higher long-term rates have pressured prices, they've actually made things more attractively valued. So we like high-quality bonds, especially in the middle of the yield curve, more attractive than we see it in years. We're pretty excited about that. On the alternative side, we continue to use these strategies to help generate more current income as well as manage risk. So we're emphasizing equity option overlay strategies that generate a very attractive level of current income, as well as a multi-sector real return strategy that offers relatively low correlation, so that helps in risk mitigation, but also helps us to offset inflationary pressure. We do think the market's going to have bouts of volatility, but we also think that we're going to see higher equity prices, stock market prices in the months ahead, especially as we end the year, we think on a strong footing. So looking at the favorite choices table, industrials, regional banks, we still like technology, and there are some areas where we favor emerging markets as well. And I mentioned the tactical overweight to the multi-sector real return. Now let's move on to the cash indicator. The cash indicator has done a nice job of reassuring investors who might be more sensitive to the market volatility. It actually gives us an opportunity to discuss volatility and put it in a broader framework. Usually volatility, so when the market swings, it's actually just it's part of being invested. It comes and goes with different market conditions, but it's typically not something to be feared. The cash indicator works as a trigger to alert us to those rare points of times where actually volatility is a sign of something worse. And the cash indicator has elevated as we've seen fear spread across equity and fixed income markets. It has elevated to reflect these risks, but not to a point where we would be cautious or concerned about it. In fact, the market was so complacent over the last couple of years during periods of time where it seemed like the market wasn't worried about anything that we become concerned about that. In this case, things are just kind of getting back to normal. We can see where the long-term trend line, how low the level of cash indicator got. That reflects a lot of basically market euphoria. Now we're getting back to more normalized times. We are seeing equity market volatility, but it's also largely offset by still confidence in the credit markets. And with that, I will close by thanking you for your time and interest. If you have any further questions, please contact your financial advisor. They'll be happy to help.